Hi, I'm David Witter, founder and CEO of Financial Office Wealth Advisors. Excited to be with you today. Lots of downward volatility last week. Markets lose somewhere around 5% in a little over 2 days. What I want to talk about with you today is what do you need to be doing now to protect your portfolio? Let me start with something called an intra-year decline. This is the concept of during the course of a year, the equity markets will have maybe a peak and then at some point a valley. So here you can see in the diagram where maybe it starts out well, then there's a big sell-off, a correction, and you can see from peak to valley in this example, 14% decline, and then it takes off. That's what we call an intra-year decline. So when doing a little bit of research, something that we discovered was over the last 72 years, an intra-year decline of 10% or more happened almost all of those occurrences. So expect a 10% decline or more for an intra-year decline. 15% more happen about once every 3 years, and a 20% intra-year decline happens somewhere around 1 out of 6 years. Expect these things to happen. Then during those times, the intra-year decline on average was 14%. Another way of saying that is each year with your equity portfolio, you should be expecting, hey, my equities at some point during this year are going to decline somewhere around 14%. And then when it happens, you won't be surprised by it. Now you might be wondering, well, David, why in the world would I take this kind of volatility with my portfolio if I'm going to have an intra-year decline of somewhere around 14%? Volatility equals growth. Look here, the S&P 500, if you started in January of 1946 versus October of 2018, where do you think the S&P 500 was then versus now? How about 18 back then? I didn't forget a zero versus 2767 here as we sit here in October 2018. That is a 153-fold increase if you stayed invested. So upward volatility is what gives you that kind of growth. You have to take the downward intra-year declines to get that kind of growth and have your equity portfolio perform well. Another thing I'll add is play the odds. If you have a 75% chance of winning, would you play that? What are we talking about here? Each year, when you wake up on New Year's Eve morning, or I should say New Year's Day morning, you have a 75% chance that that year is going to be positive for equity performance and only a 25% chance that it's negative. You can see here from this graph, this is showing you all the years that are positive in the equity markets versus negative. The odds are in your favor if you remain disciplined and you stay invested. Another way of saying this is in 2018, even with this recent volatility, there's still a great probability that it's going to end up being a positive year and giving you a positive performance. Volatility is defeated by discipline and time. Those aren't very easy though sometimes, are they? So let me finish with this. I've got a checklist of what you need to be doing now. Number one is remember your purposes. Your purposes for your investment portfolio is to maintain your lifestyle and your purchasing power during your working career as well as 30 years of old age. You have to have equity performance or have exposure to equities in the long run to make sure you have plenty of income to support your lifestyle. Hold on to those purposes. Don't forget the long-term plan. Number two, decline is expected. We saw, hey, 14% intra-year decline on average. Just expect that. But also remember those declines are temporary. They're intermediate or happen during the course of time, but that isn't the final say. They're temporary. Number four, play the odds. Stay invested. 75% chance each year that's up. And when you start expanding out over a 10-year time horizon, almost 100% likelihood that you're going to have a positive equity performance. Last but not least, rebalance and Roth conversions. What do we mean by rebalance? We'll do this for our clients. If we have a big pullback in equities, we'll sell out of maybe high quality fixed income to buy equities when they're low. Also doing it if we're taking a systematic withdrawal out for you, we'll always be selling what's performing best. But the best way to rebalance is if you have new cash added to the portfolio, you're buying into equities when they're on sale. Second, with Roth conversions. when the IRA account values or the components of that IRA are down in value, that's a great time to be considering Roth conversions where we can actually move shares of that asset category that's negative right now and pay the tax when the values are lower during these intra-year declines or these the corrections, and then pay the tax on the lower value with the expectation that once it's in the Roth, it'll continue its growth. If we can help with any of these on the checklist, give us a call. Always here to help you. Remember, discipline is what wins. Know your plan and stay invested.